This week I'm in Montreal. We've been talking a lot about empowerment, partnership, and collaboration. Speaking of which, there's been a lack thereof between China and US in regards to their trade negotiations. This could have a big impact on your portfolio. How are you protecting yourself? I'm Hilberry. If you like what you hear today, please subscribe to my YouTube channel. Let's get started. The trade war between China and US has been continuing on for more than 18 months now, with Trump using tariffs as leverage, and then China following suit. And this is starting to hurt both economies. In fact, it's starting to hurt global growth in general. The IMF has just revised downwards again for the third time global growth projections, and this is the lowest growth projections that they've had since 2008. So where are we in the trade negotiations? Let's take a closer look. To date, the U.S. government has levied $550 billion worth of goods with tariffs against China, and China has followed suit with $185 billion worth of goods with tariffs against the U.S. Now, this is starting to affect both economies, particularly farmers in Iowa. Now, Donald Trump came out with a statement on October 11, 2019, saying that the most massive trade deal has ever been signed had just occurred. Now, the truth is, China and the U.S. government had agreed to, in principle, phase one of trade negotiation talks. These were to do with agricultural products, strengthening of intellectual property rights, and currency control. Now, intellectual property rights, this is a big issue. I've talked about this before. This is negatively affecting the U.S. economy between 1 to 3% of nominal GDP. That's between $200 to $600 billion each and every year. So it's a hot button issue. The trade talks have only agreed upon in principle, and nothing has actually been signed yet. According to Bloomberg economists, trade deals with China aren't worth the paper that they're signed on, and we don't even have a deal signed yet. So how can you, knowing all of this, protect yourself from the negative effects of a likelihood of a prolonged trade negotiation or trade war? Let's take a closer look. Martin Lefebvre, chief economic strategist for the National Bank, recently commented on how the Fed fund rate had crossed over the neutral rate in the U.S. Now, in the past, this is predicated a recession. But what he said is that right now we're looking for that external shock to push us over the edge. Certainly, a prolonged trade war between the U.S. and China could do that. So the steps you should be taking today are paying close attention to the quality in your portfolio. At this late stage in the economic cycle, you don't want to be looking for companies that have high debt, high leverage. You want to be, again, focusing on quality, both in your stocks and in your bonds. For asset allocation, you want to make sure you have a nice degree of stocks, bonds, and then maybe a little bit higher cash than you normally would have. For diversification purposes, you want to make sure you're diversified across the industries, in your bonds and in your equities, and in your bonds diversified across the yield curve. This will help protect you if there's any fluctuations in interest rates. I'm Hilberry. I hope this has been helpful for you. Thank you for listening.